Hello and welcome to the Froggy Five. I'm your host, Jim Freilich, founder and managing partner of Froggy Companies. And today we have a special treat for you here. I've got Jerry Chu on the line, who is CEO and founder of Lofty AI. Lofty AI, from my understanding, I've been familiar with them for several years now. I want to say since 2019 or 2018. Jerry and his partners founded Lofty AI. It's a real estate technology company that originally was utilized to predict growing neighborhoods throughout the world. Then at some point along the way, they pivoted and started focusing on tokenizing assets, democratizing the access to these fractionalized tokenized assets. And my latest understanding, Jerry can fill us in, but my last understanding is that they're up to over 150 properties and growing that have been tokenized and owned, and over 7,000 monthly users. So we're going to go a little off script along the way here with Jerry while we have him on, and we have the privilege of asking him some in-depth questions. But I want to start out by saying welcome, Jerry.
Thank you for having me. It's a pleasure to be here.
Yes, I'm going to back up a little bit because I didn't know a lot of other things about your background. I'm assuming there's a software element here because you started a real estate technology company. But tell me how you came to be and add a little color around where you're at right now versus where you started.
Yeah. So we had a pretty interesting journey, I think, as most startups do. And we're definitely not alone here, but we've pivoted a few times, and it took us a few years to really kind of figure out what it is that we wanted to build and what kind of product would actually be useful to users in the real estate space. So originally we started out as a pure SaaS company, basically selling our software on a monthly subscription. And what we did was we built this AI that would identify up and coming neighborhoods for people. And one of the things we looked into and why we were really interested in that problem was there were all of these companies using machine learning, a lot of cool new analytics, and novel data to try to predict housing prices. And consistently, it's like the iBuying stuff and Zillow pulled out. It turns out it's actually really difficult, especially in the single family space, to predict home prices. The rationale being that homes are just too unique. They could be in the exact same street, but because of the position, which direction the property is facing, what kind of style it has, there could be huge variations on the desirability of that property, right? A great example is one time we were talking to one of our users back then, and he said they found a house that fit all of their criteria on paper, and it was quite literally perfect. And as they were walking out of the house, his wife saw like this utility pole that was like close to the house, and it was kind of an eyesore for her. And she just went, no, not this one. And they just couldn't buy it, even though on paper it was perfect for them. And so variables like that make it so that it's almost impossible to predict individual property prices accurately. But what we noticed was you could kind of sort of predict on a block level or sort of like a micro neighborhood level in terms of average price per square foot of that neighborhood. You could actually predict that a lot more accurately because it smooths out the inconsistencies. And what you're really predicting at that point is the desirability of a neighborhood, right? And we leveraged a lot of unconventional data sources like real-time data from Yelp reviews and what type of businesses were opening up and shutting down in an area to, street view images of like how the foliage changes over time in a neighborhood, to people posting about what type of dogs they have. And like those are GPS coordinates in certain areas. So we would use novel data sources like that and could sort of predict in real time where gentrification was happening. And the idea was you would sell this intelligence to real estate investors who could then go into these areas and invest early before they're well known, before the phenomenon's well known. And then at which point, think about getting into Brooklyn, like, early enough where you're not too early, but, you're like 3 years ahead of the curve. That's sort of the best time frame to be in. And you would just see much higher price appreciation than what is standard in real estate. And that could really change the performance of your portfolio over time, right?
Yeah,
and
absolutely.
So that's what we were working on. And we actually grew that to a decent amount. And, even you heard about us, for example. But one of the issues we faced was that product had really high churn, meaning that people would subscribe and they would cancel after a few months. Um, and that made it really hard to grow over time. It became harder and harder to grow the business because of that. So we reached out to a lot of our users to interview them and chat with them and see what's going on behind the scenes. And one of the things we noticed that they would tell us was, they often have full-time jobs, and real estate was kind of a side business for them because growing up, they would read about it or they learn from friends, families, or their own families that, hey, you should own real estate. Like all the wealthy people do it. It's like
Hmm.
great. You get tax
Absolutely.
advantages and like all the benefits of owning real estate. So now that they're, software engineers, some of them are like investment bankers, like they have really high income. So they start to want to deploy their assets into acquiring some rental properties, right? And they would use Lofty. They would love the product. They would find the neighborhoods and the properties they wanted to invest in. But then we had this hypothesis where if we found you where you wanted to invest, that was 90% of your problem taken care of. And you actually, making an offer, getting the deal, getting a mortgage, like getting all of that stuff closed was just 10%. It was tedious, but it wasn't actually difficult, right?
Hmm.
And it turns out in reality, it's actually quite the opposite. And so we would talk to these users and they would say, okay, yeah, I found the neighborhood. Then I made like 20 offers and, like I would fall out of escrow, or like the, mortgage provider, their inspector would say I overbid in that, but I had to, because if I didn't, I would lose the bid to someone else, and there's like all these nuances. And after a while, they would make 20, 30, 40 offers over a few months, and not a single one would close for a
Hmm.
variety of reasons, to the point where it was just such a draining process for them because it's so manual and so time consuming that they would just kind of give up and quit. And they're like, I still want to invest in real estate, but like I got a full-time job, I can only do this on the weekends, like man, like this, like I just don't have time for this. So that was one of the main reasons why churn was extremely high. So our team
Sure.
kind of went back to the drawing board and it's like, what can we do to fix this? Like, what's the thing we could do to help these people? And so we had this aha moment where we said, well, what if instead of just finding you, where you'd want to invest in, we actually just allowed you to invest in the like property directly. Like that was a product. If you found something you were interested in and you did your due diligence and you decided, hey, I'm in, like this is for me. Yeah, I have strong conviction, like I want to buy this property. There is no outcome where it's like, oh, this deal wouldn't go through. You would just be able to buy it whenever you wanted to, right? And so that kind of morphed into what Lofty is today, which is a marketplace just for people to buy and sell fractional ownership in real estate completely online. And so we have over 150 properties on the platform today. It's actually higher than that, but there's a couple properties that are hidden because they're being listed for sale by the owners.
Hmm.
We're pretty unique in terms of how our platform works relative to other fractional real estate platforms out there. First is that we are a pure marketplace, meaning that unlike some of our peers, we don't own any of the assets. We don't invest alongside our users. All of those properties, they're owned by independent owners who just come to our platform to list it for sale. In fact, any of you listening could do the same. You could list your house for sale on Lofty, right?
Hmm.
And we don't even manage the properties for you. So the way it works is, legally speaking, every property's deed is owned by a holding company. In this case, it's a DAO LLC. So this is pretty much identical to a traditional member managed LLC, with one exception where it kind of marries some blockchain concepts to it. And this is perfectly legal. It's a new type of entity that you can form currently in 3 states: Wyoming, Delaware, and Florida. And I suspect in
Hmm.
the future you'll be able to do this in all states. But essentially, the
Hopefully.
difference here is the LLC doesn't have a manager on paper. That's it. It's managed by a smart contract on the blockchain. So that's the only difference between a DAO LLC versus a traditional one.
Okay.
So because of that, we, the deed is held by this holding entity, at which point uh, the tokens represent the ownership in this holding entity. So you become a member of this DAO LLC. And so by default, if you own 10% of the holding company of this DAO, you would then own 10% of all of its assets. In this case, the deed to the property. And these holding companies don't do anything else. They don't engage in any other type of businesses. So all they do is own and manage this one asset. And so with these tokens, you're the legal owners of these properties. And again, we as a company don't own any of these tokens alongside our users. So we have no say, and therefore we can't manage the properties. And you don't pay us any management fees either. Instead, collectively as a group of owners, you would actually vote through a governance program that we've created, where typically one token equals one vote. And you guys actually collectively decide what to do with the property, how to manage it. So you can hire third-party property managers. You can elect one of your members to be the property manager if you believe that they have the expertise necessary. You can vote anytime to sell a property, and you choose what price to list it at. You can choose which agents to use. You choose how you want to do rehab and repairs and value add to the property. Essentially anything that you can legally do as a faux owner, if you were to just go out and buy your own property, you can do through this governance program as a group. The only difference is you obviously have to convince other people to vote alongside you. So, if you have some idea or, some action you want to take, it requires a 60% supermajority for the vote to pass. But as long as other people agree with you, you can basically propose anything that is legal that can be done traditionally. So that's how
Okay.
the platform works in general.
All right.
And what we've essentially done is made it so that these properties trade perpetually. It's almost like a real estate exchange, similar to how you can go on the stock market and buy stocks of Apple, and you can do that any day you want, every day. You can, sell it today and then change your mind and buy it back tomorrow, right? That type of flexibility and speed of execution and trading efficiency doesn't exist in real estate and has never existed before. And so what we've done with our platform is provide the opportunity for people to basically trade equity in real estate extremely efficiently. And now you can basically buy into the equity of any these individual single family rentals. Some are Airbnb short-term rentals, some are long-term rentals, some are HELOCs from the actual homeowners. So a wide variety of assets, but you can essentially buy into and sell out of a specific property with the same speed and ease of use as buying a share of Apple on your stock brokerage account. And so essentially we've completely made real estate a wholly liquid asset, and we're really proud of that.
Which is amazing, and this is why you're here today for this interview. And so, thanks for giving that background, because a lot of amazing point. I think I started adding up the reason why this is going to be different than some of my other interviews is because I want to drill down on some of these areas,
Sure.
selfishly, but also for the people, my growing small listenership and people that I interact with a lot on tokenization, right? Because I also, our Froggy X Factor, we consult with multiple companies that do either white label tokenization or, this whole space that you guys are way ahead of so many people in this area. So a couple of things I want to unpack. So I give that as a premise to a couple of things I want to unpack here and try to better understand. So first, on the technology side, the tool that you guys already had that I used in, I want to say 2019, I was part of that churn, by the way, I apologize, but I was with a company, but we were focused on assessing a number of incoming potential deals where ground up multifamily is happening. What I wanted to ask you is that technology, that portion of the technology, does it inform decisions today on how properties are selected to come in, or does it not? And if so, does it?
Not really
Yeah.
at all. Honestly,
Okay.
it's a very open marketplace. We only select on quality of sellers and also just quality of properties. And so,
Okay.
in theory, anyone can list. And we're not really choosing. Like, we're not investment advisors. We're not a managed fund. So we're not deciding, hey, is this a good investment or not? We're more selecting of, hey, does this person are they going to scam users?
Sure.
Right?
Sure.
Like
Yeah.
that's actually what we're like filtering for.
That's most
And
important.
the idea is long term, like pretty much our hope is that the majority of real estate is transacted in this manner in the future, and ideally through our rails and through our platform that we build. And so one of the pitch we always give VCs and people who invest in Lofty, the company, is we're building the NASDAQ for real estate. So that's really sort of the grand vision here.
Okay.
And if you want to
Okay.
achieve that, you actually can't be completely selective, like, oh, these are the best properties in the world, because then your market would just be too small, right? So it's really kind
Exactly.
of like, hey, in the future, we want all real estate traded this way. We don't actually even use AI anymore internally.
Okay.
I know it can be a little misleading because it's still legally a part of our company's name, and our domain ends in .ai. But the reason for that was just because we couldn't acquire it initially, and we didn't really look too much into it, the .com domain. And we already built sort of this brand and reputation with
Hmm.
a lot of users. And so we just didn't think it was worth it to completely rebrand and shift to something else. But that was the same realization where initially, I would say, like the first 10 properties listed on the platform in summer of 2021,
Hmm.
those were actually vetted and discovered by the AI algorithm. But what we quickly noticed was the restriction in volume. It was like, okay, well, if this had to fill the AI's criteria, there's only like so many properties you can list at any given point in time. So you just can't really grow in the way that a venture funded company can. And so we made the decision to sunset that part of the business completely.
Okay. Thanks. Well, thanks
Internally,
for
we still
explaining
own
that.
the IP and have the model. We can sort of spin it up anytime we want if we want to. But
Okay.
as of today, it's a pure marketplace. Anyone can list properties for sale. There is no AI criteria you have to satisfy.
Okay, great. Well, thanks for clarifying that. I didn't
Mhm.
even realize that making real estate like Nasdaq is, yeah, that's big. That's world changing type of thing. Like so, and you're on that track. So now that I know that part, the which raises another quick question: the underwriting that comes through. So you're basically saying, well, let me back up. I think. Correct me if I'm wrong. Within all these properties you guys have developed, you're continuing to evolve, and I think some segment of properties now that you do, the the owner's still managing for the most part, or so maybe there's a subset of properties. I'm not maybe remembering my discussions in the past with Max, right?
Yeah.
But maybe you can clarify how is it different, and then sort of wrapped up in that is like, we know how to underwrite properties well. We do it a lot. If I'm investing in a bunch of your properties, well, now I got to magnify how many times I'm doing due diligence. I'm going to make sure I do it right. If the onus is upon me to do that, what is the first underwriting on your side of the equation before it makes it onto the platform? What are the gates to get through? Like if I bring you a property tomorrow, Jerry, I got these 10 properties, I want to tokenize them. Boom. You guys, other than background checks, making sure I'm not a criminal, the normal due diligence, what are the gates, I guess?
Yeah. So that's a great question. And again, there, are no gates, and that might sound scary
Okay.
to some people, but what we
Okay.
do instead is just make everything so transparent that, anything kind of unconventional can be sniffed out very quickly.
Okay.
Um,
Gotcha.
and so what happens is, you obviously, there's a background check on the seller. So we check your credit, we check your background. Like, there have been people denied listing on Lofty because we found that they had mortgage fraud in their
Hmm.
criminal records and things like that. So that's number one. You have to be free and clear as an individual. And then the second thing is, every property has to come with an appraisal and inspection report. So we order that, but the sellers actually pay for it. And so, you're going to get your property appraised, and you're going to get a professional inspector in there. And so there's not a whole lot you could hide. Like, if there's
Sure.
issues with the roof, like, it will be stated in that report. And, based on comps, and we don't always agree. Not everyone agrees with the appraiser, right? There's no sort
Hmm.
of perfect system to value real estate properties, single family specifically. But I think it's sort of an industry standard thing where, mortgage providers and banks and individuals sort of universally say, okay, well, this is the appraised value. Like, it's kind of the standard. Um,
Sure. Which
so
is
you
good as
so
you can get with appraisers, right? The world of
Exactly.
appraising is
And
its
these
own
are just
thing.
like
Like,
normal appraisers,
yeah.
traditional appraisers. There's nothing fancy or weird going on here. So all of that information, along with any rent rolls, if you have a lease, if there's a tenant currently leasing the property, you're going to have to provide that lease. You're going to have to provide rent rolls. We're going to check, like, you have to send bank details over to be like, oh, are you actually receiving that rent? So all of those things are verified. And
Okay.
then guess what? All of that information becomes publicly available. You don't even have to have a Lofty account. Anyone looking at any of these properties can click into the documents tab and view every single piece of information I just mentioned and more. there's actually, in fact, more details in there. So if there's been any rehab work done, any maintenance work done, the invoices are in there, the receipts are in there. Yeah, and so, it's an extremely transparent process. And as a result of that, we don't really prevent any specific properties from coming on the platform, because if there's anything the seller's trying to hide, there's not a whole lot that can get through the system like that would be available. If they're like, hey, there's foundation issues, I'm going to try to hide that. Like that's pretty difficult. Like usually the inspector finds that. And same thing if they want to charge egregious fees, that's all publicly released as well. So a lot of our users are actual professional real estate investors who own, like 10 units. Some of them own like 40 units or 100 units on the side outside of the platform. And so these people know exactly what to look for, and they dig through all of this information. And we actually have a Discord server where all the Lofty owners who are verified and own at least one token in any property can join and basically discuss all these deals together and ask questions and chat with other fellow Lofty users. And so all of these get surfaced in these channels immediately. Someone will pull up and it's like, oh, this is like non-standard. I don't think this is a good deal for these reasons, right? And so the sort of community is underwriting its own deal. And we as a platform just ensure that, hey, you as the community, you as the individual user have all the possible information you could ever need to underwrite these deals yourself. So that's really the process
Yeah,
here.
I love that. I mean, that's really smart in the big picture of what's going on with this in terms of tokenizing single family rentals, especially. I know you do more than single family to a degree, but the bulk of what you have, I think, are single family rentals, right?
Yeah, that's correct.
That are in there. And that's really great because it's like for this era, for the tokenization era, for the fractionalization era, for the era of open source information and the way social media works, you're going to probably uncover a lot more quicker. And I've been amazed going on, and I look at these different properties, I looked at several, and I'm like, it's just all there. You do have to do your due diligence,
Mm-hmm.
but it's like you're getting more data. Now people realize, I'll give you an example of how this is now for someone your age, it's like probably a no brainer, but I'm probably talking, I mean, this is for some older people like me, 50s and above. It wasn't until like about 20 years ago that people realized, every camera is a sensor, you know what I mean? Every camera,
Mm-hmm.
something happens, everything's going on at once. So 20 years ago, there was, I did a lot of stuff with Homeland Security. I had a history as a systems engineer, and I
Mm-hmm.
worked for the military. I worked for Homeland Security, counterterrorism, things like that. Where there was, in one case, we were doing public health support when there was a tsunami and it was overseas, and Sri
Mm-hmm.
Lanka was affected by it, and there were public health people going over, and I was doing a report where we had to gather data and find out what's going on, or say Hurricane Katrina and what's going on in this area. And there's like the public information, right? At some point around then, 2004, there's like what's happening publicly and what's official and what all these different agencies
Mm-hmm.
and government things can put
Yeah.
together. And then there's like people on the ground running around with cameras and stuff. And there was a time when suddenly, even though it was harder to verify all that, I was getting way more quality information from just people running around on the ground.
Mm-hmm.
And so I draw an analogy to this of like, we can go through our formal due diligence, say one property at a time. Like if I were using your AI tool and it's just me, I got to do all that myself. But now when you bring in all these people with different backgrounds and skepticism, some are negative Nancy, some are like super optimistic. Now they suddenly have all this depth and breadth of data that will quickly uncover that. And that's a real free market type of thing anyway. That is like what you're trying to do with the NASDAQ idea, right? Like,
Exactly. And the
okay.
idea is kind of people keep what people like about real estate investing and then just get rid of what they don't like about real estate investing.
Mm,
So if you look at our platform, that's how we've intentionally built everything. People like deciding which properties to invest in. They like doing their own due diligence. They want to know, like they have this belief that, hey, I know more information in a certain neighborhood, maybe because I live in the city, right?
yeah.
And I actually am bullish on the city because of X, Y, Z and reasons. And in many cases, they can actually beat the market. They can beat a REIT. They can beat the national average for price appreciation and things like that, because real estate is so local. So these local people actually have a huge edge over institutional investors in a lot of cases.
Hmm.
So that's what people like to do. And we just make that process easier. What they don't like to do is hunt for the materials and to call up the seller and have to call up the agents to get the data and the information. But once you provide all of it, people love actually going through it and doing their own research. And then on top of that, the idea is you can't really specialize in more than one thing in life, right? So typically, someone is an expert at underwriting and doing the data stuff. But then we also have users who are actual contractors, and like they paint walls. There might be a painter in your DAO. And so when they look at the photos, we have people point out, it's like, hey, I do like X and Y, Z in work. Like this is shoddy work. Like
Yeah, yeah.
look in that picture. Like that is not high quality work. That's a piece of information that even seasoned real estate investors, if you don't go to the property to physically look at the wall yourself, you're looking at pictures, might not pick up on. But because someone else who has that expertise is in the same ownership group as you, they can actually surface that information. And then all we do as a business is just making sure that the technology is here so that all of this is available to you, and that real estate transactions, which is the biggest headache piece for most people, is
Hmm.
seamless and instantaneous. And then everyone's happy. All the stuff they hate is gone, and all the stuff that they enjoyed about investing is still there. So that's kind of intentionally how Lofty is developed.
Okay. Now, the governance of the property management, how does that happen? Because I know now a lot of your properties that are coming online now, the owners are still owning, I think, the majority of it, or maybe not. Like I think there's a cap to how much I, as an individual guy, can come in
Mm-hmm.
and own of equity, and
Yeah.
then there's an amount that the owner, right, is currently either self-managing, or they come to the equation with the property management in place. How does that work? How does that
Yeah,
look? In the,
that's a great question. And it gets a little complicated, but it's roughly still the exact same method where, owners get to vote with their tokens. The only difference here is we now allow people to sell a portion of their ownership. So before, you used to have to sell the entire property or nothing, right? But it turns out flexibility is what a lot of sellers need and want in the real estate market. And so we have all these people come to us and say, hey, I love my property. I just want to sell like 20% because I want to pull cash out and like invest in another thing or do something else with my business or whatever is the case. But I don't want to sell all of it. Like, can you guys do that? We started getting a lot of those inquiries. And so we developed a new governance model where we call it the scaled governance model. And the difference here is that basically your voting rights are scaled relative to your ownership percentage. So it's not always one-to-one anymore.
okay.
And I won't go into the algorithm because it's a little bit
Oh yeah,
complicated,
no.
but the rough idea, to give you an example, is if you're selling 10% of your property and you own 100% of the property outright. Let's say you have no debt, right? And you sold 10%, you would still own 90% of the property. And in that scenario, your voting rights would actually only equal 54%. So you're
Okay.
scaled down. And then the other owners who only own, like one or two tokens, their voting rights are scaled up slightly. And so it still maintains this sort of fair democratic process where you, as the majority owner, still have a huge amount of say, because again, it takes 60% to form a supermajority to pass, and you alone make up 54%. So you are still like, hey, it's very fair. Like, you own the majority of the property, so you should get the majority of the decision. But you can't unilaterally decide what to do, which is
Yeah.
incredibly fair to all the other owners, because you can't form a supermajority by yourself. So you still need to convince at least 6% of the other votes to vote alongside you for things to pass, right? And that's how that works in these scale governance programs. Now, for a lot of these newer properties, owners aren't just selling 10% because these properties have debt, right? And on our platform, we actually differentiate like a very hard line between debt and equity, right? So the
Okay.
debt portion represented by the mortgage is actually locked away in an escrow account. So those tokens exist, but they're not in circulation. And so all the seller can do is sell the actual equity portion that they own free and clear. outside of the mortgage, right? And out of that portion, once they sell down a certain percentage, they're forced to maintain at least 10% ownership. What ends up happening is a lot of times this just goes back to a normal ownership. They're below the 15% cap. And so
Mhm.
it's still back to one token voting, right? And so in a lot of cases, the scale governance program doesn't even kick in because the seller's actual equity is below the high threshold. And what
Wow.
ends up happening is as they pay off their mortgage each month, they unlock a portion of the tokens equivalent to the equity that they paid off in the mortgage, and that they basically sort of buy it from the lender, if you will, and that gets sent back to them. So they're building up their equity over time, just as as you pay down a mortgage, you're building up your equity over time. So
Okay.
same process.
Great. Well, thanks for explaining that. Something that gets that I can see how that could get complicated. But let me ask you this from a I want to understand staking. That's how we
Mhm.
got to this interview too. I think I reached out
Sure.
because I was like this staking and liquidity pools. This is what scares guys like me the most, right? Because on one hand, the whole thing about tokenization, I'll say at the very top of the list is liquidity now in something that was historically an illiquid asset, right?
Hmm.
Great. That's also it could be a double-edged sword depending on how it's handled. So when I hear about the staking and liquidity pools, being a guy that never did anything with Bitcoin and only took like a year and a half to try to understand this whole
Sure.
tokenization world, um, what tell us about it, and I'll ask you. You're a super smart guy, so you're gonna have to. This is gonna be work for you here. Start with like the sixth grade level. I won't say second grade level, like sixth graders of like,
Hmm.
okay, how this thing can work, and then tell me uh, why it should work, what can go right, and then what the risks are, if you
Hmm.
can, at
Yeah,
some level.
absolutely.
Go ahead.
That's a great question. And so, again, even though a lot of our technologies build on the blockchain, we actually sort of abstract that away, right? We view it in the same way as current products do. Like nobody brags about what database they're using, so it's the same thing.
Yeah,
Like we don't really tell you too much about the blockchain. It should just work, and the value. It should just be the benefits it delivers to you as a user. You don't really need to know or understand how the blockchain works. And so staking and liquidity pools is actually one of these things where it exists and it's optional for you to interact with it, but you don't have to. So as a result, as someone who just wants to invest in real estate, you don't really need to fully understand how it works. It just delivers benefits to you, and you have to pay a fee for it. That's as simple as that concept is.
sure.
So at a high level, what's really happening is, traditionally when you trade anything, whether it's real estate, stocks, or whatever it is, you need a counterparty, right? You're selling someone has to be the willing buyer. And that's kind of where the liquidity issue comes up, because if you list something at a price, not everyone may agree with you. And so for months on at a time, right? Like when you list a property for sale on the MLS, some properties don't sell for a whole year.
Mhm.
So, that's why people are like, well, it's not liquid. Because you rely on a counterparty to complete your transaction for you, right? So even though we made real estate fully digital, meaning that people can trade piecewise and buy and sell these tokens whenever you want to, there was still that issue of the counterparty. You might be listing 3 tokens for sale, and that's only $150. So obviously, liquidity is higher. There's more people that can buy that. But at the same time, if you list it at a price that people don't agree with, the $150 of worth of order might still sit there for a month before it trades. So the way that stock markets now are very liquid is because in reality, when you make a market order, you're not actually trading with the other person sitting in front of their laptop executing an order. What happens is that there are these entities called market makers, and
Mhm.
they basically come in and all they do all day long is they buy and sell shares of the same stock. So there's this big company like buying and selling shares of Apple, right? And so when you buy shares in Apple or sell shares in Apple, you're actually trading with this entity. And because they're doing it constantly, that's why your order goes through pretty much instantaneously. You're like, oh, okay, I just click a button and I've sold my shares in Apple. Like, isn't that great, right?
Mhm.
You're not actually truly trading with the individual or a counterparty in that sense. And so in Web3, or blockchain in general, people created these algorithms to mimic market makers because that's what's required to keep a market liquid. Um, But a traditional market maker, they make money from buying and selling these shares, right? Like they're not just doing this service for free. They
Yeah.
buy your shares at a slightly lower price and then they resell them at a slightly higher price. That spread is their profit margin. And so if they do this enough, they actually make a very decent amount of money throughout the year. And that's and they use their own money and they raise that money from investors and things like that. And that's where they get the liquidity and their capital from. So what people did was they built these algorithms that can do the same thing as these centralized market makers do. So these algorithms are just, think of it like a trading bot. It's just buying and selling tokens, shares, and whatever you design it to do, right? And
Hmm.
it does the exact same thing and creates a very liquid market. So now all of a sudden, as a buyer or a seller, you don't need to wait for another person to complete your transaction with you. You just sell it or buy it from this bot, right? But this bot, because it's on a company, it has no capital, it has no liquidity of its own. So where does it get the money to trade with you in the first place, right? That's where these liquidity pools come in. Think
Okay.
of them like vaults that exist digitally on the blockchain. And these vaults accept deposits. You can deposit the property tokens in our case, and then you can also deposit USDC, which is basically dollars, but the blockchain representation of dollars, right? It's a stable
Hmm.
coin. So you can deposit these assets into this vault. And what the algorithm is doing, it's borrowing assets from the vault to trade with people. So when you sell tokens in a property, the algorithm will actually borrow some USDC from the vault, from the liquidity pool, and it will use that USDC and buy those tokens you're selling. So now from you as a real estate investor, you're just like, hey, I clicked a button and I traded. Like it went through instantly. I just sold my tokens. Like this is great. It's exactly like how I trade Apple shares on my brokerage account. And that's how we create this sort of instantaneous trading and this liquidity. Now, why would anyone lend assets into this vault, right? What do they get out of it?
Hmm.
Because there's risks involved, of course, right? The reason is because in order to use this instantaneous trading, instant liquidity, which doesn't exist anywhere outside of Lofty and has never existed in real estate before, people should be willing to pay more. Like, you want instant liquidity, like you got to pay a little extra to be able to unlock that. And
Sure.
so we as a platform, the way we make money is we don't manage anything for you. So we don't charge management fees. We don't take a cut of your profits or your earnings. All we do is we charge a trading fee. Like if you don't trade, we make no revenue. But if you're buying tokens and you're selling tokens, anytime there's a trade occurring, we have a percentage fee associated with that trade on our platform. And so for market orders, for instant liquidity, you have to pay an additional fee. So you pay our fee, but you also pay an extra fee to the algorithm, right? And to the trading bot. And the bot, it's not a real person, so it doesn't need money. It passes off that revenue to the people that have lent out their liquidity to this pool. So why do people lend out their money? Well, is because they earn a yield on it. It's basically like debt. Like you get to lend out your money and in exchange make revenue from this, algorithmic trading bot, right? So that's kind of where all the economic incentives tie in. So there's technically two sides of the market. On one side, you have people who are essentially using the liquidity for trading, and these are just the real estate investors. And all you need to do at that point is that, hey, trading is instant. And if I want to use this feature, I got to pay extra money for it. That's it. That's all you need to know. You don't need
Yeah.
to understand any of the blockchain concepts, and it will just work for you. Then on the other side, it gets a little bit complicated. Typically people who use it understand these blockchain concepts more, but they're willing to lend out their capital, both equity in the real estate property that they purchase, as well as dollars. They lend these assets out so that they could be used for trading, and in exchange they get a yield. And a lot of times these yields depends on the frequency of trading, and depends on essentially the more trading that happens, the more fees it collected and the higher your returns. And so in many cases these liquidity pools will pay out yields in double digits, which you compare to the risk-free rate of roughly 5% these days. People are willing to take the risk on that if they think, they can consistently get 20% yield from lending out their assets, right? So that's how they interact with that side of the market. They supply the liquidity. So that's how it works at a high level. And I
That
think,
was a great explanation. It was high level enough for a sixth grader maybe to understand. I'm not sure. It's been so long since I've been in sixth grade, but I think you did a really good job explaining it. One thing um, I guess if I'm staking my tokens, if I
Mhm.
understand it right now that you've explained it to me, um, if I pull my money out, what are the sort of risk around me staking it? Should I really be willing to leave it there for a year, for 6 months, or what?
Mhm.
And then don't I get a penalty if I pull it out?
Yeah. Yeah,
How does that
absolutely.
work?
Those are great questions. So, if you're scared and you don't want to take on additional risks, you can just use the real estate side. This is purely optional.
Yeah,
You're not
just
forced to
explain.
stake or anything like that. I just want to make that clear to the users. So you could just trade with instant liquidity and be happy. And it's completely optional in that sense. But should you choose to use this, there are definitely some risks. One of them is called impermanent loss. And so, for example, let's say in total there's $1,000 in the pool, right? And that's a combination of multiple people have put in that $1,000 collectively, and someone comes along and they sell some tokens. Well, what does that happen? Two things happen. Based on supply and demand, when there's selling pressure, prices go down. So the algorithm will lower the price, the new market price of the property after this trade. And a portion of the USDC will be used up to purchase these tokens. So now there's no longer $1,000 left in the pool. So if you then come back and say, hey, I put in $100 of the $1,000 and I want all of it out, you're not able to get all of it out because there's just physically not the same amount of money in there anymore. And
Yeah,
so that's known as impermanent loss. And the reason it's impermanent is because, well, the idea is that it's temporary. So as the token prices get lower, in an efficient market, people will see that and go like, oh, prices have gone down. Like, this is a great buying opportunity. The yield is higher at my lower entry price, and I'm getting a deal on this property. So people will bid up the price again. So they'll buy tokens, and then the reverse happens where tokens get taken out of the pool and USDC get put back into the pool. And at which point you can then take out your original $100. And then throughout the process, you've earned the yield for lending out your money as well, right?
yeah,
But for a
yeah,
brief period, and that period could be as low as a few seconds to as high as a month or 2 months or even 6 months, just depends on the trading frequency and the amount of liquidity supply. What ends up happening could be, hey, there's not enough USDC in there, so you just can never get out your original principal. And if you did, there's a new mechanism that we've introduced. One of the issues with these algorithms and liquidity pools in general is that there's a flight of capital. And that's like a big thing that plagues the decentralized finance space, where
hmm
you can't really sleep soundly at night, because at 3 a.m., what if everyone else pulls out the money and leave you as the last person in the pool? And then they get their money out, but you can't get your money out, right?
yeah,
So
yeah,
it's all speed based, like who gets out the door fast. But that creates this perverse incentive where everyone's scared, and so everyone's trying to get out constantly, and liquidity doesn't actually stay in the pools, which is not what you want. So we actually created this new mechanism where when the pool is in balance, right? There's not enough liquidity on one side, and you try to pull out more capital from that pool to further imbalance the pool, you would actually be charged a penalty fee. So you can do it if you're happy to pay the fee, right? But there is a penalty fee associated with it. And we don't keep that penalty fee. That penalty fee actually gets paid out as rewards to everyone else on that side of the pool that isn't leaving. So now the incentives have been completely flipped, where in reality, and the penalty fee is variable. So the more you put the pool out of imbalance on your withdrawal, the higher your penalty fees will be, right? And
yeah,
so what ends up happening is, in practice, if you were the last person in the pool, everyone else would have had to pay so much penalty fees to exit, that you would basically be made whole being the last person in the pool. Like you would have lost most of your principal, but the rewards you would have gotten from everyone else's penalty fees would have basically made you
Made
recover
up
your
for it, right?
principal.
Yeah,
So now all of a sudden you can sleep soundly. The incentive is like, I kind of want to be the last person in the pool.
yeah,
And because of that, everyone thinks that way. And so, people aren't really seeking to exit when the pool is in balance, which further helps the liquidity and gives it time for it to rebalance. So that's kind of where that mechanism comes
that
in.
is great, Jerry, because it's really genius. A few things you guys have done here, and you're really on the front edge of something big. The way you're doing it, and the way you're thinking through things. And I'm sure there'll be other things that are going to come up down the road, and you're going to continue to evolve with this. But that is so good because it makes perfect sense to me now. Puts in a perfect perspective a guy who does have an engineering background and now is enough to be dangerous with tokenization to say, okay, now as an investor, right, I'm investing not only my own money, but millions of dollars of other people's money in stuff that I understand how it works in the old school world, which everybody's still mostly doing, right? We still have this old sort of lethargic way of doing real estate that a lot of people think will stay that way. And then another bunch of people think it's going to be like Bitcoin. But then you have you guys that are like understand both of these worlds. And I think what you just explained there is sort of like the equivalent of you've done a checks and balances that wasn't available in the 1920s when people were making a run on the bank at savings and loans, like in the It's a Wonderful Life. We have like Jerry's It's a Wonderful Life digitized thing. Is like, okay, now you've signed that, but now you're going to be penalized because you can't just all come here and pull out this debt, basically your debt tokens that you said you would leave available, because this is a system of checks and balances, right? And this is all secondary to the much more straightforward side of what you have, which is investing in properties and a communal way of doing due diligence that might be more efficient than historically doing it. So it's a really interesting ecosystem. I'm going to have you back again at some time too, because I don't want to take too much of your time. We're already, I guess, hitting up against our wall here, but it's been a fascinating discussion. I really appreciate you taking the time to go in depth on that.
Glad to be here, and thanks for having me on.
Yeah, thanks a lot, Jerry. We'll catch up again later. And people want to get in touch with you, they can probably hit you up on LinkedIn.
You can find me on LinkedIn. You can reach out to our support team on Lofty, and they'll forward it over to me. You can also find me on, formerly Twitter, now X, under PMDBT. That's my handle. And so, lots of ways to follow me if you're interested.
Okay, awesome. Thanks, Jerry. And I look forward to really digging in and just doing more investments myself in staking and liquidity pools and just.
Yeah, absolutely. Don't be shy. You have any questions, you know how to contact me. Feel free to reach out whenever. Happy to chat with our users.
Thanks a lot, Jerry.
Thanks a lot, Jim.
Hey, thanks for having me on. If anybody else wants to find out more about what we're doing, please come to froggycompanies.com. Check out our 3 different business areas. We also have the Froggy Fund 1 that's now open for up to $18 million. We're going to be investing that $18 million across a diverse number of assets, cash flowing and ground up. And I'm really excited about this fund and really confident that we can outperform most of the other people out there in terms of what we invest in and how we do our due diligence and the type of partners we put together. So it's great talking to you, and see you next time.